All right. Well, thanks again for having me. It's great to be here and welcome to all of you. We'll spend about an hour together today talking about the golden one-day options trade. These are power play trades for volatile markets. And in fact, regardless of whether you trade options or not, this is going to be critical information. So you're going to learn a lot of really valuable insights and tools and tips and tricks to even use in your equity, ETF, futures trading, whatever markets you like to trade. But we are going to be focusing on one specific option strategy, a very powerful strategy called the golden one-day options trade. So before I dive in, I'll just cover a quick legal disclaimer with you. Trading securities and options involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and of course need a broker to trade securities and options and must meet suitability requirements. We will be going over some various results in our sessions today. I do my very best to share real world, real money results to back up everything that I teach on these sessions. But just know that anything that I do share, due to the time critical nature of trading, brokerage fees, activity of other traders, etc., we don't guarantee anyone will mirror that performance. All right, so by the end of our session, you're going to discover one trade setup that has the potential to profit regardless of whether the market goes up or down. Now, these opportunities occur on a regular basis with astounding reliability. You just really need to know how to spot them and how to trade them. So whether you're just starting out or you're a seasoned veteran, this is must-have information for today's markets. So let's talk about some of the difficulties that we face in trading and investing. We're going to first kind of start out talking about directional trading. So when we talk about directional trading, really one of the most difficult aspects of trading is accurately and consistently forecasting and timing market direction, right? If we all had a crystal ball and we knew which way the market was going to go at any point in time, that would make things a whole lot easier on us. It's not a guarantee of success. You could still, use poor money management, risk management, et cetera, and blow up your trading account, but it would make things a whole lot easier, right? And unfortunately, we don't have that. But there are some things that get very, very close, all right? And that's one of the things we're going to focus on in the session today. So I'm going to talk a little bit about volatility and how that comes into play in our trading. So this is a equity market volatility tracker that's put out by the St. Louis Fed. And we're looking at about a year's worth of data here. And I really wanted to encompass that tariff sell-off that we saw in February and March and early April. But I'll point a couple things out here. Number one, volatility over time is kind of steadily increasing. Okay, so it contracts and expands, and we're going to talk about the importance of that. But when we're in an expansion mode, right, it's going to steadily increase. And the other thing to point out, okay, is that it's erratic. So we've experienced this, right, in recent markets. We get big vol spikes followed by big vol contractions. Okay, and those repeat themselves. Okay, but they're in some ways unpredictable. So I want you to keep those two things in mind and how they tie into the difficulty of forecasting market direction. Because even if you get the direction correct, it can quickly reverse on you, and most of us have experienced that. But what if we don't need to know whether a stock will go up or down, or even when? Okay. We're going to eliminate this difficulty with the golden one-day options trade. So we don't care which way the market goes. It can go up, it can go down, and we don't need to time it. Okay, so we're removing two very, very critical difficulties that all of us encounter in trading and investing. Okay, so what I'm going to give you today on our session to make it easier, you're going to discover the golden one-day options trade. I'll show you how to identify the setup, how to trade the setup, how to profit from the setup, how to apply the setup to any optionable security. We'll look at some real world, real money trade examples, and then stick with me to the end, and I'll show you how you can get expert guidance to do this for yourself in the live markets. So we have a whole lot of great stuff to cover on the session. Before we dive in, I'll just give you a brief background on myself. Again, I'm Jeff Tompkins, and I have over 2 decades of experience trading the stock, options, and futures markets. Received my professional training at Morgan Stanley as an intern at the trade desk back in the early 2000s. And a decade ago, founded Altos Trading, where I'm the chief investment strategist. We've rapidly grown to over 60,000 members in over 100 countries across the globe. I'm also a hedge fund manager, so I do manage money for my clients at Altos Capital. And in fact, the strategies and methodologies that I'll be sharing with you on the session are those that I incorporate into my hedge fund, which has been very successful since we launched it about 6 years ago. We've never had a losing year, and we've traded through some very difficult, market environments, the COVID crash, the bear market of 2022, the recent tariff crash, and we've had positive years every year. And I really credit a lot of what I'll share with you on the session today with that. So As you can see, I'm also a keynote speaker and educator. This is me up on the stage at one of the International Traders Expos. So I love getting out and educating and watching, struggling retail traders transform into confident, consistent traders. So that's really why I'm here with you guys today. All right, so let's start to dive in. What if we could profit if the market goes up or down? Okay, so again, we're going to remove that directional difficulty that we all face. So we refer to this as a market neutral strategy. Okay, now with the Gold Monday options trade, there's no special indicators needed. Okay, there's no complicated chart analysis. In fact, we can do this trade without even referencing a chart. We are going to incorporate a little bit of chart analysis because there's a method that will give us a little bit of an extra edge. But you can actually do this without even using a chart, which is really cool. And there's no guessing trend direction. Okay, so we're not trying to predict where the market's going to go, and we're not trying to time when it's going to make a move. Right? It can go up, it can go down, and it could do it today, tomorrow, a week from now. It doesn't matter. Okay, there's no uncertainty when to take profits, so we're always going to know what our profit targets are, and it's going to be based on one very simple statistic. Okay, and it's very reliable. Okay, so we're not guessing. We're not using lagging indicators to try to determine when it is appropriate to get out of a profitable trade. And this is all a proven strategy based on statistics. Okay, so at Altos we're very big on statistics and positive expectancy. If you're not familiar with the positive expectancy formula, you can Google it. But it incorporates a number of variables that many of which are often overlooked. Often in the retail trading world, people focus on win rates or, the risk reward ratio. Those are only parts of the equation. Okay, to have a system or a strategy that has a positive expectancy requires a lot more. So again, you can Google that and check it out. But everything that we do is built on positive expectancy. So what that means, you can kind of think of the analogy of a casino, right? They have a positive expectancy in all the games they offer to their gamblers. They know that as long as people are playing those games, that statistical edge will play out over time and they are essentially guaranteed to make money. Okay, well, that's how we look at trading. So we have systems that have positive expectancies, and as long as we execute them, according to plan, then we know that they have the statistical edge to make money over time. Okay, so that's what the golden one-day options trade is all about. So you're going to discover why volatility is one of the only leading indicators of impending trends, how to identify when markets may be primed for a big move, how to build a trade that can profit regardless of which way the market goes. So again, like today, the S&Ps are up, right? About 0.7% right now. Okay, that's great. We could be making money with the Golden Monday options trade, but it wouldn't have mattered if the S&Ps went down 0.7%. Doesn't matter. Okay, we're going to look at how to set accurate profit targets with limited defined risk. Okay, so with the Golden Monday options trade, we always know our risk up front. We know what that risk is from before we get into the trade, from the start of the trade all the way to the end of it, and it doesn't change. Okay, so everything is defined as well as the profit targets. We know where we're going to take profits. We'll look at how to play smart money trades. And what I mean by this is we're going to be using a statistic and information that is highly underutilized in the retail trading crowd, but nearly always incorporated into institutional trading decisions. Okay, and so you're going to walk away today with a big edge and some methods that are used in the institutional trading world. Okay, and there's a whole lot more. So we got lots to cover. Let's start to dive a little bit deeper, and we're gonna talk a bit about volatility and how we're going to incorporate this into the Golden Monday options trade. So there are different types of volatility, namely historical volatility and implied volatility. So one looking at the past, the other looking forward. And we're concerned with forward-looking information, right? So we're going to focus on implied volatility, which is basically the option market's forecast of future price movements. So it tells us with a high degree of accuracy how much an underlying asset's share price is expected to change by a future date. So this is hugely valuable information. Even if you don't trade options, if you're just trading the underlying stock, right? Imagine what you can do with that information. You can use it to set realistic profit targets, realistically define your risk. Okay, there's a lot of things we can do with this information. Use the appropriate strategy. We're going to get into that because that's a big mistake that retail traders make is they might do all the correct technical analysis, but they select the wrong strategy for the market environment or whatever the conditions are at that time. All right. Now, this data is readily available for any optionable security. So the options chain is actually going to tell us the exact number of points the market is forecasting the asset to move up or down. All right. So I'll give you just a quick high level overview of implied volatility because I want you to have a basic understanding of it. If you and maybe many of you do, but if you don't, I want to make sure because this is important in understanding what we're about to get into. So implied volatility is a measure of how much the market expects the price of an asset to fluctuate in the future. And it's a key factor in determining the price of an options contract. So there's a direct correlation. When implied volatility levels are high, option premiums become more expensive, right? And when implied volatility levels are low, option premiums are relatively inexpensive. Okay. So traders use IV to gauge whether options are cheap or expensive and to determine the possible outcome of an options trade. Okay. Now, IV is influenced by supply and demand and the market's expectation of the amount of stock will move. So it tends to increase ahead of a major announcement and then decrease after the event has passed. And the analogy I like to use is a company's quarterly earnings, right? So if you plot implied volatility on your chart and you reference it leading up into a company's quarterly earnings release, you're going to notice that implied volatility is steadily increasing. And then it peaks right around that announcement. Once the quarterly earnings results are known, implied volatility drops off a cliff. And we call that volatility crush. Okay. So if you've ever bought a single leg, call or put option prior to a quarterly earnings announcement, and maybe you were even correct about the directional movement. Like you thought the stock was going to gap up on quarterly earnings, so you bought a call option. But maybe let's say the stock gapped up like 10%. Maybe you didn't make much money on that, or maybe you even lost money. Okay, this is very likely due to volatility crush. Okay, so keep that in the back of your mind. Now, IV is measured on a scale from 0 to 100 when we look at IV percentile. So this is kind of my interpretation of it. So an IV of 0 to 20 I consider to be extremely low, 20 to 40 quite low, 40 to 50 more in the medium range, 50 to 80 moderately high, and then anything above 80 I consider to be extremely high volatility. Okay. Now IV forecasts the expected move up or down of the underlying security with remarkable accuracy, but it's not perfect. And that's perfectly fine. We don't need it to be perfect for the purposes of the golden one day options trade. Okay. But over the long run, it is very, very, very accurate. Now, it also doesn't tell us which direction the underlying stock will move. Once again, perfectly fine. We're going to use it in a whole different way. We don't care which way the market goes. It can go up, it can go down. We just want to have an idea of how much it might go up or down. Okay, and so we're going to get into that in just a second. So let's hop over to an options chain and put this all into practice. So we're first going to look at using implied volatility in forecasting movement, okay, in the underlying. So this is an options chain of the SPY. It's not current. It's from back on October 6th of last year. It doesn't matter. We could really look at any options chain. Now, at this point in time, the SPY is trading around 573 a share. Okay. Now, I'm doing this out of the Thinkorswim platform, so this information might be found in a different location on your respective broker platform, but it should be in there somewhere. If you have any trouble finding it, I'll give you kind of a quick and dirty way to estimate this. But if we go over to the right of the expiration cycle, okay, and we're just going to go out one day in expiration to October 7th. Okay, we look over to the right, we see a percentage and a number. Okay, we're going to ignore the percentage. It's basically an annualized vol percentile. What we want to pay attention to is that number, which in this case says plus or minus 3.98. Okay, what is that number telling us? This is what we call the expected move or the implied move. Okay, and it's telling us that the SPY, and we can round here for simplicity, right? We can round it up to 4. It's pretty close to 4. Okay, the SPY is expected to move up or down by roughly 4 points over the next 24 hours. Okay, that's what this is telling us. So once again, imagine, what we could do with that information. Well, there's a lot of things. For instance, if we bought shares of the SPY, we were, let's say, doing an intraday trade, and again, SPY is trading around 573. We get into a long trade, it's moving in our favor. We're wondering, well, where do we take profits? Okay, would we want to set them up at 574? Well, if we add 4 to 573, we get 577. So there's a very low probability that we're going to trade up to 574 by the end of October 7th. Okay, so that would be an unrealistic profit target. What about a stop loss, right? We get into a long trade. We want to define our risk. Do we want to place a stop down at 570? Okay, maybe there's information on the chart or from an indicator. Maybe we see a support level and that aligns with the 570 price level. And we think, well, let's put our stop there. Well, you're going to have a potentially high probability of getting stopped out because it's inside the expected move. So this is kind of some food for thought, some ideas of what we can use this information for. We're going to use it in another way, okay, to build the Golden Monday options trade. But again, if you have any trouble finding this in your broker platform, a quick way to estimate is just add up the at the money straddle. Okay, what that means is you take the strike price in the options chain that's closest to the underlying share price. So again, SPY's trading around 573. We go to the 573 strike and we just add up the call and put premium at the offer. Okay, it's going to give us a pretty close estimate of that expected move. All right, so let's start to look at some option strategy and how we're going to use this information. So again, we're going to focus on non-directional, market-neutral option strategies, and there's a bunch of them out there. I'll give you some common ones and some of the drawbacks, like an iron condor. Okay, so iron condor consists of a bear call credit spread, a bull put credit spread. So it's a four-legged strategy, and it has the potential for consistent gains, but it carries a high risk relative to reward. Okay, so it has unfavorable risk reward skew, meaning you can, have a series of small winners wiped out by one bad trade. Okay, so we're not going to be using iron condors. Another is iron butterflies. Okay, these have limited risk, limited reward, and they basically profit when the underlying asset stays within a narrow range. So they can be a little more challenging. Okay, in terms of accurately forecasting where the price is going to end up by a future date. So we won't be using iron butterflies. Another is short strangles. Now, short strangles involve selling out of the money call and put premium, okay? And they have limited profit potential, limited to the credit received, and unlimited directional risk. So the problem is if you do get a strong directional movement while you're in the trade, the strategy can experience heavy losses, okay? So we're not going to be using short strangles. What we are going to build into the Golden Monday options trade is a long strangle. Okay, so the long strangle has limited risk. It's always capped at the debit you pay for the trade and unlimited profit potential. And we don't need to guess the trend direction. Okay, so this is a market neutral strategy. We don't care which way the underlying asset goes. It could go up, it can go down, doesn't matter. Okay, but there's some critical things that we have to get right to trade this successfully. So we're going to start to dive a little bit deeper and get into that. Okay, but the long strangle is what we're going to build into the Golden Monday options trade. So I'll just walk you through what this strategy is real quick if you're not familiar with it. Okay, it's basically an option strategy where the trader buys a call at a higher strike price than where the current underlying share price is trading, and then a put at a lower strike price. We use the same expiration date. It's on the same underlying asset, and it's used when the trader believes the underlying asset will make a large price movement but is unsure of the direction. Okay, so that's great. We're not going to concern ourselves with which way the market is going to go. Now, the strategy has limited defined risk, as I mentioned, so it's limited to the debit you pay, and has unlimited profit potential to the upside, substantial profit potential to the downside. Why not unlimited to the downside? Because theoretically, the underlying can't go below zero. Okay. Now, here's the beautiful part. We do not need to predict the trend direction. Okay. We're not going to be using any lagging indicators, any discretionary decision-making, guessing, stock tips, throw all that out the window. Okay, we don't care which way the underlying goes. Okay, trend direction does not matter. We're going to be using a very simple statistic that has a very high probability of success. Okay, and we can profit on a significant move up or down in the underlying asset. Okay, now if a strong directional move does not occur by expiration of the option contracts, the strategy can also be adjusted to mitigate risk and even generate a net profitable outcome. Okay, and I'm going to give you a couple tips and tricks to adjust these positions as well when things don't go as planned. Okay, now we're going to incorporate one other thing into this, and that is zero DTE or 0 days to expiration. So these are relatively new offerings, new products that were rolled out to broader retail crowd back in 22. Okay, which is when the CBOE announced that it would issue weekly options with expiration days on each day of the week. Now these aren't available for every optional security, but more and more are becoming available. And These are basically option contracts that exist for a single trading session. So they expire in the same day that they are traded. Okay. Now, what's interesting, and this isn't strictly limited to zero DTE. If you look at just short duration expiration cycles, okay, and there was a study done by the NYSE just recently, looking at 5 or fewer days to expiration. Okay, a huge percentage of retail volume is now centered around these short duration contracts. So they found about 56% of the entire retail trading options volume is in short duration contracts. Okay, so what this means for us is there's incredible liquidity. Okay, so we're not going to have any trouble getting into or out of trades. Okay. And there's just a lot of interest in these short duration contracts. Now, zero DTE option prices, and this is important because it's why we're going to incorporate zero DTE into the golden one day options trade. They're significantly impacted by short-term moves in the underlying security. Okay. So you can take the exact same option strategy, okay, a long strangle, if you will, or it could be a vertical spread or a calendar spread. Okay. You give that same strategy, and we're going to use it on the same underlying security to two different traders. Trader A trades that strategy on, let's just say, an option contract that expires today, a zero DTE. The other trades it in an expiration cycle 30 days out. Okay. Now, both of the trader A and trader B are going to be exposed to the same movement of the underlying asset, right? Those trades are going to behave, even if they're the exact same options trades, same strike prices, same number of contracts, they're going to behave very differently, okay, because of the difference in the expiration cycle. And there's a reason for that. And I'm going to get into that here in just a second. But what this means for us is there's significant profit potential for those who know how to take advantage of it, okay, and you will know how to take advantage of it here very shortly. Okay, so why is that? Why does that difference exist for different expiration cycles? It's largely due to gamma. Okay, so this isn't something you'll have to calculate for the golden one day options trade. This is just purely for background understanding. Okay, so gamma and zero DTE options. Well, first, what is gamma? It's one of the Greeks, right? And it measures the rate of change for an option's delta based on a single point move in the delta's price. Okay, so it's basically a risk metric that measures how quickly an option's delta changes in response to a $1 change in the price of the underlying asset. So for zero DTE at the money options, gamma's at its peak, which means that small changes in the underlying asset's price lead to large changes in the option's delta. So this is what I was referring to between trader A and trader B, trading the same strategy on the same stock, the same strike price, the same number of contracts, but different expiration cycles are going to have drastically different results. Okay. Now, we're going to harness gamma to our advantage. And if you know how to do that, okay, it can have a huge benefit to the short-term trader. So this is why we're using short duration option contracts. Okay, so let's start to dive deeper into the strategy, okay, and using implied volatility. So we've already looked at the expected move or the implied move. Okay, we've identified how to spot that. We're just going to come back to the same options chain. Now, at this point in time, again, this is back on October 6th of last year. The SPY was trading right around 573. Okay. We're just going to go one day out. So I referenced zero DTE, but we can actually do this trade with one DTE as well. So either or, it's kind of up to you. We just don't want to go more than one day out in expiration. So in our example, we'll just go out to the next expiration cycle, October 7th. Okay. Now, we've already identified that back on October 6th, the SPY was expected to move up or down by roughly 4 points. Okay. Now, I want to point something out in terms of the expected move. It is highly unusual for this expected move to not be reached. It's a very small percentage of the time that it does not. A high percentage of the time, it's that those levels are reached. Okay, and it's very common to see price reach that level and then reverse. And there's another pretty high percentage of the time where it's exceeded. And that all of those are okay. We don't want that small percentage of time where that expected move is not fulfilled. Okay. But all the other outcomes are perfectly fine with this. If it exceeds that expected move, all the better. Okay. So what are we going to do with this to build the golden one day options trade? Step one is to buy a call and a put with strikes near the outer edge of the implied move. So we're simply going to add and subtract that expected movement number from the current underlying share price. Okay. So that would tell us that we would need to buy a 577 strike call, right? Because we're just adding, and again, we'll round here, adding 4 to 573. Okay, so we'd go up and buy a 577 strike call. If we subtract it, it would tell us that we need to buy a 569 strike put. Okay, so we've now built a long strangle, one day out in expiration, that has an extremely high probability of reaching one of these strike prices. Okay, so we're buying relatively low deltas here, right around 20 deltas. Okay, for relatively low premium. And we're going to talk about the cost of this trade here in just a second, because we need to define our risk and our reward, right? So first, defining risk. We've already talked about the max potential loss for this trade is the premium you pay for it. So it's whatever you invest into the trade, right? We don't need to use stop losses. We don't need to guess where you should get out of the trade in the event of an adverse move, right? There's no such thing as an adverse move. The SPY could rally to the upside, or we could have a market crash. Okay, we'll have the potential to make money in either outcome. Okay, so our risk is defined always. Now the fun part is defining our reward. So with the golden one day options trade, we target a 50 to 100% ROI, or return on capital, in a day. So we simply add up the premium that we pay for the put and call contracts, and we predefine our exit price. So we always know, even before we route the order to our broker, before we place the trade, get into it, what our profit target is. We don't need to identify profit target levels on a chart. We don't need to use any fancy indicators. We don't need to use any guesswork. Okay, I'll walk you through an actual example and show you. Okay, so that's step two. We add up the put and the call premium to determine our total risk. So in this example, we could put this trade on for 93 bucks. You can literally put this one DTE long strangle on for $93. Okay, the 569 strikes are offered at 66 bucks. The 577 strike calls are offered at 27 bucks. Okay, so you can do this inside a small account, absolutely. Okay, this can be, and it's all scalable. Okay, you can up the number of contracts based on your risk tolerance and your account size. Okay, but that's the cost of this spread in this example. It's 93 bucks. All right, so we then need to set our profit goal and add the total premium paid for the strangle. So again, this is where you just do a little quick basic math. Okay, and I'm going to give you a little pro tip here. In our example, we're going to target 100% return. So whatever we invest into this trade, we're looking to double our money. Okay. So we simply take the cost of the spread, right? The put premium, the call premium. Okay. $1.86 would be our exit price. That's our limit price, because again, we're looking to double it. So we have two options here. We can place one limit order to get out of the entire long strangle at $1.86. What I prefer to do is option number two, where I place two separate limit orders, one for the call side and one for the put side. And the reason for that is there are occasions, and I'd actually have to check today. We may have had an example today because markets initially rotated lower and then reversed. But it's these types of scenarios where you can, in some occasions, hit the profit target on both sides. So you can actually, hit a 200% ROI potentially. So I like to use two separate orders. Okay, and that's why I kind of run this calculation. All right, so step 4 is then to submit our GTC, that's good till canceled, limit order for both the call and the put side of the strangle at $1.86. Okay, so we're simply looking for that premium on either the call and the put side, because remember, we don't care which way the market goes. Okay, it could go up, it could go down. We're just looking for that premium to hit that $1.86 limit price. Okay, so we've identified the SPY is expected to move up or down by roughly 4 points by the next trading day, October 7th. Let's see what happened. Okay, so we fast forward to October 7th. Again, we didn't care which way the SPY was going to go. In this case, it went down. Okay, there wasn't a market crash or some dramatic sell-off. It was down 0.95%. Okay, but it did exceed the expected move. So it fulfilled it, right? Remember, that was 4 points, but it exceeded it a little bit. Okay, 5.44 points to the downside. Excellent. We all the better. Okay. What happens to our 569 strike puts? Remember, those were purchased the day prior for 66 a contract. They traded up to a high on October 7th of 254 a contract. It's a huge, huge percentage increase in just a day. Now we don't care what happened to the call side. Okay, those contracts are going to be worthless. We don't care because we easily hit our profit target, which was what? Remember, $1.86. So we easily hit that. So if we did a 10 lot on this trade, 10 contracts, we have a $930 profit in a day. Okay, that's the power of the Golden Monday options trade and harnessing gamma and using the expected move to our benefit. Okay, so we do these with our members at Altos. Here's some real world examples of some we've done recently. This one we did last month in September on the Qs, the QQQ. Okay, so we got in, okay, on September 16th for a $1.45 debit. Now it is important how much you pay for these. And I'm going to give you some more tips on these as well in just a minute, because there are some things you need to look out for. But this is a pretty reasonable price for one DTE long strangle on the Qs. Okay, $1.45 debit. So you could do this trade for $145. Okay, less any brokerage commissions and fees. Okay, you can scale it up to 10 contracts. Okay, which is what we're doing here, which is an investment of $1,450. Okay, here we were looking for a 50% return on our investment in one day. Okay, the reason being was the current levels of implied volatility. Okay, if they had been lower, and they were steadily increasing, we probably would have shot for 100% ROI. But again, that's kind of another little pro tip, and I'll give you some more of those here in just a minute. But if we fast forward to the next trading day, September 17th, we got out of this trade for a $2.15 credit. Okay, that's a $705 profit potential on 10 contracts. Okay, 50% return on investment in just one day. So here are some tips. One thing that we want to avoid is vol crush or volatility crush, which occurs after an anticipated event that results in contraction of price movement. So I gave you that example earlier of a company's quarterly earnings announcement, right? After that binary event and that unknown information becomes known, right? So there's not all the uncertainty that existed leading up to the event. Vol drops off a cliff. We get vol crush. Okay, remember implied volatility is the main component in how options are priced. And there's a direct correlation. So if implied volatility drops off a cliff, so does the option premium. Okay, that is not something we want to encounter with a long strangle. Because implied volatility is a major component of options pricing, it can cause the option premium to decrease rapidly, which can negatively impact the value of the calls and the puts in the strangle. And because long strangles benefit from an increase in volatility, we want to place these trades when we expect volatility to increase or remain high. So we want to avoid vol crush. Okay, that's a pro tip. Now I mentioned we don't even need to reference a stock chart to do this trade, but we can incorporate a little chart analysis to kind of build in a little bit more edge. So I'll just show you some quick price action analysis that I like to use with the Golden Monday options trade. And it's a good way to kind of just get a kind of quick gauge of volatility, okay, using the candlestick range. Now, first thing to understand is volatility always alternates between contraction and expansion, okay? So when we're in vol contraction, okay, this is when you'd see the VIX, coming down or at low levels. Okay, we're typically going to see a more narrow high-low range of the candle. And when we're in expansion, that high-low range is going to widen. Okay, so if we just look at the high and the low of the candle, that's a good kind of estimate of whether we're in vol contraction or expansion. Okay, but just remember it always alternates. So like if we look at this chart over on the right, okay, on the very left, right, we have the far left candle is pretty narrow, high-low range, right? But then we notice the second candle, the one to the right of it, it widens. So there's a range expansion, okay? And this often, again, corresponds to vol expansion. Okay, we see those candles widen, then we get a rotation lower in the asset. Eventually that sell-off stabilizes. We see, once again, vol contraction, so the high-low range narrows. Then it widens, then it narrows, then it widens, narrows, widens, narrows, so on and so forth. Okay, so it always alternates. Okay, so we want to place, again, the golden one-day options trade when we're in vol expansion. Now, occasionally, there will be periods when the underlying asset doesn't fulfill that expected move. Okay, and we may be facing a loss in the trade. So we can't completely avoid losses. They're a part of all trading. Okay, and really they're our biggest overhead in the trading business. So we just want to minimize them as much as we can. And there are some ways that we can adjust these trades. Okay, when we don't fulfill that expected move or we get caught in vol crush. Okay, and one of those is the sell premium on both the call and the put side when the market doesn't move as expected. Okay, so we can convert this long strangle and either into an iron butterfly or an iron condor to bring in premium to cover loss in the long call and long put when the market's flat and in vol contraction. Okay, and we've done this a couple of times. Fortunately, we don't have to do it very often, but we've done it a couple of times recently, and we've actually taken trades that would have been a losing trade, converted it into either an iron butterfly or an iron condor, brought in more premium than we originally paid for the strangle, and actually ended up coming out with a net profit. Okay, so often when we execute this correctly, we can either mitigate a loss or even transform it into a losing strangle into a net profitable strangle. Okay. Now, the beauty is, as I mentioned, these can be traded within small accounts. So if you're just starting out, okay, $500, these are doable. Okay, as we looked at in the SPY example, you could have put that trade on for $93. Okay, so these can be done inside a small account. They can be done in large accounts. Okay, it's all scalable based on your account size, your risk tolerance. Now, I'm going to introduce you to something really cool that we introduced not all that long ago. We actually just came up on our 1-year anniversary, and that's our Altos Live Trade Room. And in the Live Trade Room, we trade a whole host of strategies across virtually every asset class. So we don't just do long strangles. Okay, we trade a variety of equity strategies, ETF strategies, other option strategies, futures, currencies, even crypto. Okay, and we meet twice a week on Tuesdays and Thursdays. It's a 2-hour session. So we trade the last 2 hours of the U.S. equity market session from 2 to 4 Eastern. And I'm going to let you know how you can join our live trade room and learn a whole lot more beyond the golden one-day options trade. So this is just one of the strategies that we use in the live trade room. And I'll share with you just right out of my this is, again, I always use real money, real world. Okay, I'm not going to give you some hypothetical example. So this is right out of my personal trading account. Over the course of a week, I just did one golden one-day options trade per day on the S&Ps, okay, from July 30th to August 7th. Okay, so these aren't cherry picked, they're consecutive trades over the course of a week. And I wasn't trading some, crazy size. I was just doing a couple contracts. Only had to make one adjustment on August 5th. So I adjusted one trade on August 5th. Okay, and booked $3,900 in profit. Okay, just doing the golden one-day options trade. Okay. As I mentioned, we also do futures. So we have some really powerful future strategies that we use in the trade room. This, again, is right out of my personal trading account, my Thinkorswim account, just trading the E-mini S&P futures using the strategies that we teach inside the live trade room. Okay. So you're going to have an opportunity to learn all of this and how I do it. Again, I'm not going to guarantee you'll replicate any of this, but I will show you exactly how I accomplish trades like this. We also do have some really powerful equity strategies that we use. These are, again, real world, real money examples right out of my personal trading account. They're not cherry picked. They're consecutive trades over the course of, again, 1 week. And again, I'm not doing anything crazy. I'm not trading 10,000, shares or 20,000 shares, anything crazy, right? In some cases, just a few hundred shares, and booked over $4,500 in profit using, again, one of the strategies we use inside the live trade room. This is we keep a track record of all the trades we do inside the live trade room. We still have a few carrying over from October, so we don't have the full October track record capped yet, but had another good month. This is from September, our full track record from the month of September. We set up a live trade room sample portfolio. We did over $11,000 in September, and these are all the trades. And yeah, we have a few losses in there, but our consistency is very, very good. And again, this is incorporating all the strategies that we use inside the live trade room. And I think that there's even some Golden One Day options trades in there, like the one we did on September 16th. You can see that one in there as well. All right, so now I want to make a promise to you guys. I want to help you have days just like these, and I'm going to give you access to trade alongside me in the Altos Live Trade Room. So this is an invitation to join me to discover how I make consistent income in the markets day after day, week after week. I don't hold anything back. So unfortunately, we only have about an hour together today. I wish we had a whole lot more time, but that's what the live trade room is for, is to join me for a couple hours twice a week. And actually, I'm gonna let you know here in just a second how we get together another time. So we're actually meeting 3 times a week. And I reveal all of my special techniques, the indicators that I'm using, everything that I use to achieve the results that I've shared with you so far possible. Okay, I don't hold anything back. I don't give you a redacted version of anything. Okay, I'm not, again, going to guarantee you're going to replicate anything. I'm just going to guarantee that I will give you everything I'm using to accomplish this. So I'm going to walk through everything that you get for part of the Timing Research event today, which includes an annual membership to our Altos Live Trade Room, exact entry and exit signals, okay, live interactive trade sessions. Again, we meet twice a week for those during market hours. You get members area access for all the replays and recorded training sessions. Okay. You get full support and coaching from me. So I'm there on all the sessions. Okay. You're free to ask questions. We bounce ideas off each other, share success stories. Only limitation is I can't give you personalized individual advice. Okay. But these are all proven strategies, tools, and education. Okay. Based on decades of number one struggles, all the struggles that I went through, right, that I've overcome that took, in many cases over a decade. Okay, I'm giving you the end result here, and an opportunity to trade alongside a professional hedge fund manager, which is probably not an opportunity you're going to find anywhere else. I don't know of any other hedge fund managers that will let you join them and watch, then let you look over their shoulder while they trade, right? I don't know of any out there that will do that, but this is that opportunity. Okay, so I'm here to help you cut the learning curve and start trading like a pro. And you can literally start today. Okay, so there's even more in this package. I'm going to walk you through everything now, and then I'll let you know how you can get this. Okay, so you're going to get exclusive access to our Altos Live Trade Room. Okay, we normally retail an annual membership for $47.64. You're going to get access to real-time options alerts outside of the trade room. So even if you're not able to join us during the live trade room hours, that's perfectly okay. Okay, as I mentioned, we record all of them. You can still learn, you can watch the recordings, and we issue a lot of alerts outside of the trade room. So you're going to have a lot of opportunity outside of the trade room. Okay, so we're throwing in some extra alerts as well, which normally retail for $9.97. You're going to get weekly coaching sessions with me on Tuesday. So we do a group session, live strategy session every Tuesday at 7 p.m. Eastern. And kind of like we did today with the Golden Monday options trade, we cover a new strategy each week. Okay, we also do a market overview, map out key levels, and host a ticker roundtable where all of our members can throw out, stock symbols or tickers that they're interested in analyzing, and we run an analysis on those. Okay, so we're actually getting 3 meetings a week. I'm there on each of those. My personal coaching typically starts at $19.97 and goes up from there. You're also getting invitation-only Facebook group access to our private Facebook group of I think we're around 900 members now. We normally retail that for $199. You're getting a whole lot of other education. So you're going to get access to our online course, our professional trading series, which is over 10 hours. of our very best strategies. We normally retail that course for $6.97. Okay, you're getting that as part of the package as well. And ultimately, you get to learn to trade stocks, futures, forex, options with consistency, which of course is priceless. Now we're throwing a couple bonuses in, so we're going to build this value up even more. You're also going to get my latest indicator, the price action pivot indicator. I'll show you what that looks like in just a second. It normally retails for $97. It's a very powerful indicator. There's no lag. It's purely based on price action, and it very accurately identifies key turning points in any asset. Okay, so this is great for your directional trading. You also get my latest ebook, course. So this is another online course, How to Win 97% of Your Options Trades. This is a very powerful option selling strategy that we use with our members at Altos. We've been doing it for 10 years. I've been doing it for even longer, my personal trading account. And we've actually exceeded 97%. So we've closed out around 99% of our option selling campaigns as net profitable winners. I'm going to show you exactly how we did that. It's all in the course. Okay, and you're getting that as part of the package as well. So the total retail value on this package is over 10 grand. Okay, you're not going to pay anywhere near that. We're knocking 88% off, and you can actually get this at a quarterly option. Okay, so you don't even have to book the whole year up front. But over the course of a year, this will save you 88%. Okay, 88% off the retail price if you went and got all this from us individually. So $2.97 a quarter breaks down to pennies a day. Most of you are probably paying more to your broker and commissions than this. It's an incredible steal. So for that reason, we do limit this to 25 seats. Okay, you can still get any of these things from us. You can still join the live trade room. It will go back up to the retail price once all of those seats are scooped up. So if you want to get in at that 88% discount, the link is altostrading.com/LTR for live trade room. Okay, all you need to do is go to that link, lock in one of those 25 discounted seats, and you get this entire package valued at over 10 grand. Okay, incredible steal. And I believe David will put that in the webinar chat for you guys. Yep, thanks, David. He's already got it in there, so you can just click right out of the chat box there and lock in one of the seats before they're all scooped up. So again, you get the two bonuses. This is the price action pivot indicator. Okay, this is what it looks like on the TradingView platform. You can see the incredible accuracy of the identification of key turning points in trends. Okay, there's no lag to this indicator. Okay, it accurately identifies key turning points in an asset or trend changes using a unique pivot point analysis that helps confirm a valid pivot. It forecasts short-term and long-term trends with astounding accuracy. It works with stocks, ETFs, futures, forex. You can apply it to any asset, and you can screen for trade opportunities in a matter of seconds on any time frame. We actually have two versions of this indicator. We have a basic version and a pro version. We're giving you the pro version, which allows you to define more user input so you can set different profit targets, risk reward parameters, etc. You're getting the full version. I love using this indicator to supercharge my directional option strategy. So I do place directional options trades. Okay, and this indicator helps me time those trend shifts to get into the appropriate directional option strategy and remove the guesswork from my trading. Okay, so currently this indicator is available on Wealth Charts and TradingView. Okay, so you get to select which platform you want that indicator on. And if you don't have a TradingView account, you can set one up for free. Okay, they do have paid subscriptions as well. Okay, but we don't have any affiliation with them. But those are the two platforms. And then again, you get bonus number 2, the How to Win 97% of Your Options Trades online course. Okay, valued at $397. Okay, I want to make sure I leave a little bit of time for Q&A, so I won't go through all of our testimonials, but we do get thousands of testimonials from our members at Altos. I'll just share the one at the top that came in from one of our dear members, Himanshu, who wrote into me and said, Jeff was so on the money about SPX expectation today that he placed a 0 DTE put trade at 10 a.m. his time. He's in California, and he was out when the market closed at 1 California time. He said the option expired on the SPX, and it was successful. And so we get a lot of these. And again, that's why I'm here. I want you guys to be my next success story. Mainly the reason I do this is to hear stuff like this. Okay, so I'm hoping that you'll be my next success story, but it really only takes one winning trade to potentially pay for your package to the live trade room. So go ahead and secure your spot now. Again, altostrading.com/LTR is the link. We do have a guarantee as well. Okay, so if you don't make at least your membership fee back in the first 90 days, we're going to give you an extra year of the live trade room access on the house. Again, that's a $4,764 retail value. Okay, even if life gets in the way, you get busy, and you don't have time, that's fine too. Maybe you're only paper trading, and we encourage you to do that with any strategies. You're getting familiar with it, and before you risk your hard-earned money. If all you do is paper trade for the first 3 months, well, then you didn't make any money, and that's fine too. Just write us in, and we'll comp you that extra year. Okay, we want you to be successful, and we're here to help you do that to achieve your goals. Okay, so I'll go ahead and open it up to questions, but I also want to give you our contact information. We have both contact support email and a phone number. So email is support@altostrading.com, and our toll-free number is 800-895-9348. So if you want to reach us outside of this session, that's how you do it. And David also got our support email in the chat as well. Thanks, David. Okay, so I'll go ahead and take questions. If you guys have any, you can put those in the chat. Looks like Dirk asked, are the live and coaching sessions recorded? Yes, they are all recorded. So both the Tuesday and Thursday live trade room sessions are recorded. And so once you join, you're going to get a members login and access to the live trade room members area. So that's where you'll join to watch, the live trade room sessions. You'll find our full track record in there. You'll find all of our alerts, our alert posts. We also offer push notifications to all of your smart devices. That's where you'll get that set up. We do send everything out by email as well. And then you'll find all the recordings. So once you join, you're immediately going to have access to a year's worth of education from the past year of the live trade room. You can go back and learn a whole lot of stuff. Okay, but yeah, if you're not able to attend, not to worry. The recordings are there after each session. You can watch them at your leisure and learn. And again, we issue a lot of alerts outside of the trade room. John asked, what are the trade room hours? So again, those are Tuesdays and Thursdays. And we trade the last 2 hours of the U.S. equity session, so 2 to 4 p.m. Eastern time. We do some intraday trades, but not every session. We never force trade, so it depends on the market conditions and environment. So occasionally we do intraday trades if market conditions are appropriate. We set up a lot of pending orders that might get filled outside the trade room. So most of it is not real time critical. Okay, it's really just the intraday trades that would be time critical for you to be there. But I would just estimate 90% of all of our trades are not time critical. You have ample time to get into these, even if you're not attending the sessions live. And then again, we hold the strategy sessions, which again is going to be similar to kind of what we're doing today, where we cover new strategies each week, like the Gold Monday options trade. And then we do a market overview, map out key levels, and hold our ticker roundtable. Those are Tuesdays at 7 p.m. Eastern. And again, those are recorded as well. So you'll find those in your members area. All right. Got kind of an unrelated question. Which AI do you believe is best for traders and investors? Interestingly, I'm actually creating a course currently about AI for traders and investors. I'll let you know when it's available. You can, if you want to be on the list to be the first to get it, you can just go to altostrading.com and join our list, and you'll get notified once that's available. It's a bit of a complex question. I don't think there's one size fits all AI tool for all traders and investors. Since it's still relatively new, a lot of it's pretty niche. So there's not, I don't think at this point in time, one size fits all tool. So there's certain things that are, like insight and, you can use ones that aren't even specific to trading and investing like ChatGPT. But I think what's important is you recognize which one is the right tool for the right strategy or market environment. And so that's what I cover in the course, but it's a pretty in-depth thing. Good question there. Questions on the package. So you're always grandfathered in at the 88% discount. So we never raise the price on you. Once you've locked in that discount, it's yours for life as long as you want to have it. But we don't lock you in the contract. So you're free to cancel anytime. Most of our members stay with us for many, many years, and we hope you do too. But That's totally up to you. We don't lock you into anything. They're going to ask, what is the realistic monthly win percentage you can expect following your strategies? To be honest, I hate throwing out win percentages for a couple of reasons. Number one, win percentages actually don't matter. They're a part of that trade expectancy equation, but they're only one small component. Because you can have a strategy that wins 20% of the time and has a positive expectancy and makes millions of dollars. You can have a strategy that wins 90% of the time, and loses money over the long run. So our win percentages are high in the trade room. Again, without going through and calculating, I couldn't give you an exact, but we probably win between 80 and 90% of our trades. Maybe somewhere in there. Again, don't quote me exactly because I would need to go tabulate all of it. But yeah, we win a high percentage of the trades. But the more important thing is the expectancy. Let's see. I got a question. If signing today or this week, can I begin in March of 2026? Yeah, that's perfectly fine. If you want to lock in the discount now, we can put your subscription on hold and we can start you whenever. You can just shoot us an email or call in to our customer support and we can activate your membership when you're ready to go. Yeah, perfectly fine. Yeah, if you want to make sure you lock in that discount before it goes up to the full price. Oh, got a clarification on that last question. I was referring to the portfolio growth percentage. So when we closed out October, I think we were about a 60. So our first full year, again, we still had some trades open, so keep that in mind. But in terms of closed positions, we had a 60% return on the account, the live trade room account. So 60%, because we started in October of 2024 of last year. So I actually looked at the S&Ps for that period of time between October of 24 and October of 25. They were up 15% over that time period. So we 4x'd, 4 times the return of the S&P in the trade room. Good question. Yeah, so going back to that one, yeah. So we would bill you now if you want to lock in the discount, and then we would put you on hold. We'd start it up, and then you would then the normal billing would resume. Let's see, if you started in March, April, May, in June. So that's how that would work. All right. Well, I want to make sure I leave the next presenter plenty of time. So I want to thank all of you for attending today. I hope you got a lot out of the session. And welcome to all of our new members who are joining. I'm looking forward to working with you and seeing you in the live trade room tomorrow. So we'll be meeting tomorrow as our next session, our second session this week. So looking forward to seeing you guys there. I'll throw up our contact info one more time, just so you have it. And if you have questions after the event, feel free to reach out to us. Big thanks to David and the Timing Research team. Always a pleasure to be here. And looking forward to the next one. David, I'll pass it back to you.